Everyone, Richard Norris here. In today's video, I want to talk to you about how to invest during a recession. Now, before I jump into the granular details of today's video, if you don't know who I am and you're new to the channel, two things. First of all, please make sure you go and subscribe to the channel and hit that notifications bell because you'll be notified of any new content that I bring. And lastly, if you like this video, please make sure you go ahead and hit the like button. Now, with that said, if you don't know who I am and you are new to the channel, then my name is Richard Norris. I've successfully grown a multi-million-pound property portfolio. I have over around 400 clients that I work with in any given 12-month period, and my group of property companies makes around 200K a month. So with that said, and without further ado, let's jump in. So how to invest during a recession. So in today's video, I really want to talk to you about movements in interest rates and what this means for you as a property investor. Now, I know like right now that we're, talks of like being in a recession, inflation being an all-time high, and there's lots of uncertainty and instability in the market is causing people to be fearful. And I totally understand and appreciate that. And hopefully in today's video, my goal is to make sure that you can feel safe and more opportunistic about the opportunities in today's market when it comes to property. Because if you're fearful and you're not doing anything, then that's also not serving you, and that is adding more uncertainty to your current lifestyle as well, which isn't going to serve you. So my job on this video today is to give you the insights into the market, what I'm doing as a successful property investor, my forecast for the future, what I see happening in the market right now. And I just basically want to share with you as well what's working for my clients. So first and foremost, we'll talk about the movements in interest rates. And like I say, what that means for you as a property investor. I want to touch upon the market opportunities, because whenever there's a recession, there's actually a huge opportunity. And some people in the recession end up doing nothing, and they end up basically losing their job, or basically life becomes more difficult for them because maybe they take a pay cut as well, right? But whenever this happens, unfortunately, we live in a world of dualism. So whenever there's good, there's bad. Whenever there's a downturn, there's an upturn. And whenever people aren't making money, other people are making a lot of money, right? And I hopefully want you to be one of those people that makes a lot of money, which is one of the reasons why I'm creating this video for you today. So hopefully I can highlight and give you some more insights on the current market opportunities. Then I'm going to share with you some of the best strategies that you can adopt as a property investor right now. I'm going to share with you the strategies that I'm using right now, my clients are using right now, and what we're seeing as what's worked for us and why. And then I'm going to give you some key takeaways. And in my mastermind program, Property Investors Accelerator, we host 2 live collab calls a week. And on those calls, we all come together, we collaborate, we learn, we share insights, and we basically talk around topics like this. So I just want to basically at the end of today's video show you and basically inform you about what we've learned as a group and as a community, what we've spoken about on the masterminds, about the current market recession, and how we're capitalizing on that. And I'm going to share that with you as well. So first and foremost then, what are the most recent changes that are having an impact on property investors? So I think the first biggest one is the increase in the base rate. So LIBOR is the base rate of England, and it's recently gone from 0.25% all the way up to 3% in a very short space of time. And what this has meant for us as buy-to-let property investors is that interest rates have increased from around 3 to 3.5% in a limited company all the way up to about 6 to 6.5%. Now, why is this a problem for property investors? Because typically speaking, what happens as a property investor is we rent the property out and then we have an interest-only mortgage. Now, if our mortgage interest rates are coming to an end, and now we're used to paying 3% and now we're having to pay double, it means that we're making less profit as property investors. And it can be a problem, it can be a nuance, but it also as well, I'm going to show you in today's video how you can kind of offset that, right? And why it isn't something that you should necessarily be fearful about, but it's something that you should be mindful about. And I'm going to share with you how you can basically do property calculations and how you can stress test and financial model things so that deals are still profitable at the higher interest rates. And alternatively as well, I'm also going to share with you how having higher interest rates in today's market has also created an opportunity for new property investors to enter the market, okay? Now, typically what we're seeing as well is like one of the best things that we're advising our clients to do right now in today's market is we're basically advising them to basically put all of their deals on discount and tracker mortgages, right? And basically what that means is it means that as the base rate changes, so if interest rates go from say 3% base to 3.5% base, your mortgage will go up 0.5% as well. well. It will basically go in line with what the current market conditions are doing and what the interest rates are doing at any given time, whether that be up or whether it be down. Now, in today's market, based on future predictions, basically, and again, this is only my opinion, but it's an educated opinion from, again, being in masterminds, being around people that work for top banks like Investec, and talking with people like Kent Reliance, Shawbrook Banks, people like these who are big property players in the market, big mortgage lenders. Having spoken to them around what they think is going to happen in the next 6 to 12 months with the current interest rates and therefore buy-to-let mortgages, we're seeing that we think that in the next 6 to 12 months that actually mortgage interest rates are going to start to flatline. So we feel that right now mortgages are obviously very high, but we feel that there's been a real steep, aggressive increase in mortgage rates. And we think that in the next 6 to 12 months, these are going to start to flatline. So where we're advising all of our clients previously to take out sort of 3 to 5 year fixed deals when interest rates were an all-time low of 0.25%, we're now saying to people, hey, if you're buying a property, go on a discount or a tracker rate, because if we fix in for 2 years on a discount or a tracker, there's a good chance that within 2 years' time, the mortgage interest rates are going to be lower than what they are today. There's obviously no guarantee of that. But again, when we look at market trends, when we come together as a community, when we collaborate, like that's the economic drivers that we're seeing. And I'm going to explain and go through this in a bit more detail as we touch upon the points throughout this video today and go through these points here on my Google Doc. But basically, we're suggesting that you go on a discount or a tracker rate because you're able to basically get a better rate. So rather than paying around 6% for a 2-year fixed, you may be able to get a discount at around 4.5% to 5%. Now, if you take out a discount now, whilst you may see one slight increase in the lifetime of the 2-year tracker, and you may see it go up slightly, we still think that it's going to be lower than a current 5-year fixed deal, which is around 6.5% at the moment on interest-only mortgages for a buy-to-let landlord. So this is one of the reasons why we're suggesting go on a tracker as well, because let's say, for example, in a year's time, if interest rates start to drop and become lower than what they are today, what that basically means is that you're going to benefit. You're going to benefit from paying 0.5% or 1% less than if you were to fix in for a 5-year fix now. Because we think that if you fix in for a 5-year fix now, like you're going to be paying a premium for that mortgage. So if we see that in 2 years' time, the interest rates start to settle, and within that 12 to 24 month period, things start to flatline or even get less, then being on a tracker, you're going to benefit. And at the end of that 2-year period, once we have more certainty about what the future holds for the market in terms of interest rates and more stability, you can then fix in your deals then. So that's just something that I'm doing across my portfolio right now, and I advise my clients to do as well, is just to go on those tracker rates, right? The next thing is like thinking about things like debt coverage and rent affordability. Well, one of the biggest changes that has happened recently as well is that whenever you are investing in a buy-to-let property portfolio and you're a landlord, you basically had 145% debt coverage ratio at 5.5% interest rate. So what that basically means is that, let's say you take out a buy-to-let mortgage and the interest rate is 5.5%, and your monthly payments, let's just say it worked out to be £300 a month, your rent, in order for the bank to lend to you, would need to be 145% greater than the interest-only mortgage of £300 if that's what you're paying at 5.5% interest rates. Now, one of the biggest problems we see at the moment for buy-to-let investors is that this stress test, this rent affordability and debt coverage check that the banks are doing, they've now said that you need to show 145% of debt coverage and rent affordability at 7 to 7.5%. Now, basically what this means is that you need to invest in high yield areas where the yield is around 8% if you want to maintain a 75% loan to value. So if you're, say, for example, a new property investor, typically you'd take out a 75% loan to value mortgage because that's the maximum borrowing that you could get, which means that you could put down only a 25% deposit. But now the problem is that if we have to meet the bank's criteria of 7 to 7.5%, what this typically will mean, if we're in a low yield area in the UK, somewhere like Oxford or London, for example, where yields are very low, like 3 to 4%, you're going to have to put down more than 25% deposit, and you might be looking at like 40% deposit in order for you to be able to hit that 7 to 7.5% rent coverage affordability at 145%. So that would mean that you'd have to put in a greater deposit and you'd have to probably accept a lower return, because usually speaking, not always, but generally speaking, from like a high level rule of thumb, if you invest in a buy-to-let property and you put down a 40% deposit, the more cash that you put into that property, the lower your actual ROI, which is your return on investment. Therefore, typically if you were entering the market now and you have to have 7 to 7.5% stress testing at 145% debt coverage, then effectively this means that you'd have to put down a bigger deposit and accept a lower return on your investment, which means that your money's not working as hard as it was before this recent rent affordability increase, right? Now, there is a new YouTube video that I'm releasing over the next week or so, which is called the Rent Affordability Crisis. Now, if you're new to property and you don't understand what rent affordability is, what debt coverage is, I would encourage you to go and check out this Rent Affordability Crisis video. And in there, I basically talk about what rent affordability is in the granular detail. And I show you some calculations in order to show you how to actually calculate that and work it out. And the reason why this is important is because those that know something do okay. But from my experience, those that understand something at the granular level always do much better. So if you don't know what rent affordability is and you're not sure what I mean by 145% debt coverage at 5.5% interest or 7 to 7.5% interest, then I'd really encourage you to go and watch this Rent Affordability Crisis video on my YouTube channel, okay? After you finish watching this one, it's going to explain to you, like I say, everything about rent affordability crisis, and I'm going to talk to you about what this is. But the thing is as well, like, this is also an opportunity, right? So effectively, basically, why is this an opportunity if you're a new property investor to the market? Well, if you previously have a buy-to-let property portfolio and your debt coverage was 145% at 5%, but it was very tight, meaning that you only just hit 145 at 5%. Now, I can tell you from having done this and from experience over the last 4 to 5 years of working with really high net worth individuals and everything in between, new property investors, existing property investors, I have a number of property portfolio dashboards on my desk, and I can tell you that most people that we work with who are existing property investors do not have things dialed in at 145% and 5.5%. They typically adjust at the 145% at 3.5% interest rate, and then when it goes to like 5%, they're around 125 to 145. So they've only just got things dialed in. And basically what this means is when they go to get new lending on their portfolio, or if the banks do a check for basically the renewal of their mortgages, that the banks will see that actually, hey, at the 7 to 7.5% level, these people that we lent money to and have mortgages with us no longer meet our criteria. Now, what that could mean is one or two things. It could mean that the bank refused to lend to them at 75% on any new purchases. In order to reduce this and get new lending, they would have to basically put more money into the portfolio and basically put down bigger deposits on new properties going forward. Secondly, it may mean that actually the banks say to them and turn around to say, hey, we're not going to give you any more lending until we see that your portfolio is 145% debt coverage, a 7 to 7.5% interest rates. Until we see that you have a rent coverage of these numbers, we are not going to lend to you. So you can see for an existing property investor that this is a problem, because if they can't get new lending, they can't expand their portfolio, and therefore they're not able to grow or scale, but they're having to debt consolidate. Now, if they don't have excess capital or excess funds to be able to pay down the mortgages, they may be in a position where they're forced to sell their properties. Now, this creates what I call down here more motivated sellers into the market. So if we get more motivated sellers into the market, this is a prime opportunity for you as a new property investor to go and negotiate discounts on deals and get what we call below market value deals. Now, this is a good thing if you're new to the market, not so good if you're an existing investor in this situation. However, this can be solved, but if you don't have the solution where you have excess cash to pay down the mortgages, or you can't restructure the portfolio to meet this new sensitivity analysis lending from the banks, then you are in a problem and you are forced to sell, which means you become a motivated seller. Now, we don't want to be a motivated seller as a property investor, but we do want to approach motivated sellers. So again, you can see clearly there, if you're new to the world of property investing and you're looking to invest, like why now would be a great opportunity to be able to go in and make money, because you'd be able to go and negotiate those deals. And remember, like, everybody wants to invest when the market's strong. Like you get a sudden surge of investors that want to invest in the market when interest rates are basically at an all-time low, because they think they can get cheap lending. But the truth is, when interest rates are at an all-time low, you create competition. And so it's actually really hard to get a deal, right? And what we actually saw during like COVID, the pandemic, we actually saw a lot of people struggling to get deals and property investors struggling to get deals because everything was going over market value. The opportunity to negotiate a discount was no longer there because the market was so strong and people knew that it was so strong. Vendors were holding out for the best price. But because things have changed and because we're entering a recession and everybody started to become fearful, existing property investors, existing landlords are no longer coming from a place of strength and abundance. Some of them in these unfortunate circumstances where they don't meet the new criteria and the new sensitivity analysis, and they can't pay down their mortgages to meet that, are unable to get new lending to grow the business. And in other situations, they're forced to sell because the properties are no longer making a profit because interest rates have risen to the point where no longer are their deals profitable. And that basically creates a sense of fear, a sense of scarcity for them, and they therefore become motivated sellers, which is a great opportunity for new investors to come into the market who have got who are starting from scratch and want to do things the right way, or existing property investors like myself who understand these granular metrics and have a portfolio where even at 10% interest rates, we're still making profit. We're able to come from a position of strength and basically expand our portfolio and capitalize on the market opportunities by going in and negotiating some of these motivated sales from distressed landlords who are in this situation where they can't get future lending, they can't pay down their mortgages, and also are basically in negative equity or are no longer positively cash flowing. They're having to subsidize their mortgages every month, which isn't a place that they want to be. Now, one of the things that we're basically saying to people is that if you really want to get like these stress testing levels of 145% at 7 to 7.5% interest rates, you basically need to invest in areas of basically low house prices to high rent ratios. That basically means that you need to invest in areas where the yield is typically around 8% plus on normal buy-to-let properties. So if you had a portfolio in say Oxford or London and it was just a buy-to-let portfolio of say 2-bed or 3-bed terrace properties where you rent out to a single individual or a family, and your yields are nowhere near 8%, you're really going to struggle to hit 145% at 7 to 7.5%. And with the interest rates rising, you're going to be in a position where you're not coming from a positively cash flowing place. Your portfolio is going to be negatively cash flowing. Basically, what am I doing? So if I'm investing in new properties, every deal that I do now is basically in the northwest or the northeast of the UK. If I'm just doing single let, buy to let properties like 2-bed terrace, 3-bed terrace where I'm renting out to single occupants or a family, for example, right? If the yield is 8% or more, then I can still make margin. But if the yield is lower than that, because of the interest rate, the cost of my mortgage is costing me more every month, anything below about 8% yield, your cash flow is tight, like you're not making profit. And so this is one of the things that you can think about. If you're new to the market and you live, say, for example, in the southeast, or you come from a place like I do, which is Oxford, where house prices are very high, and you have basically high rent to high house price ratio, then your yields are going to be basically a lot less than 8%. They're going to be around the 3.5% to 4%, as I mentioned earlier. And you're basically not going to be making the profits that you want to be making. So if you're looking at a 2-bed terrace property or a 3-bed terrace property and you're looking to scale your portfolio and you're new to the market, I would highly recommend looking in areas of the country where the yield is like 8% or more. Now, this is a problem, like I said, just to touch upon this point again. This basically means that your loan to value reduces when you invest in areas which have high capital growth rates but low yields. So again, as I said there, as I alluded to, if you're investing in Oxford, for example, or in the southeast of the UK, where you've got high capital growth but low yields, you're going to basically see that you need to put down more deposit, so more like 30 to 40% deposit, and take out a 50 to 60% loan to value on your property, and you're not able to maximize or leverage that property to its maximum potential, and you're going to have to basically settle for a low return on your investment, right? And these are all some of the reasons why people no longer think buy-to-let is profitable, or they think that it's not as a good investment as it used to be. And that holds weight to some extent, but on the flip side, there's a lot of opportunity for new people coming into the market who are cash rich or are thinking about getting into property for the first time and don't face these nuances around an existing portfolio that doesn't meet this criteria of 145% rent affordability at 5.5% to 7.5% interest rates. Now, again, I'm going to explain this in the granular detail with calculations, metrics, numbers in this rent affordability crisis. It deserves a separate video, and therefore, like I say, I would encourage you to go and watch that after this one to understand this in the granular detail. Now, some of the other things we've seen is that has deterred people from investing in the market or investing in things like HMOs, where you have house share, is like increase in energy bills. Because of the increased cost of energy bills, HMOs, basically, if you're a landlord renting out a HMO, notoriously across the UK, you'd be expected to pay those bills yourself as the landlord. And if our energy bills are going up, that our cost base is increasing, we actually make less profit, right? But again, I'm going to share with you why now is the best time to invest in property, or a great time to invest in property, should I say, and why there's a particular market opportunity if you are new to investing, and why I'd encourage you to think about investing in the property market as a safe commodity and something that's going to help you through. There's a saying that says this: don't stand still and do nothing out of fear, right? Because a lot of people at the moment are basically standing still. They're very fearful about the property market. They've heard on the news that, hey, interest rates are rising, job security doesn't exist, people are going to be laid off. It's the biggest recession we've had since 2008, where the financial crisis was. And people are starting to get very fearful about investing in property, right? And I understand why you would have reservations, and it's really important to do your due diligence. But equally, like, there's such a big opportunity in the market right now that I want to share it with you. And again, I allude to the saying I said earlier and the meme that says that Warren Buffett basically said, which is, he said, when the masses are fearful, dig for gold. And I fundamentally believe, because of the points I'm going to share with you here, why now is a great time to invest in property if you're thinking about it, right? There's a saying that goes, buy property and wait, don't wait and buy property. Everybody was waiting for like interest rates to be the lowest they were, then they would think about investing. But the problem is nobody knows when bottom is. Nobody knows when house prices have gone to the absolute bottom where they can basically get the best deals, and nobody knows where top is. So we're always guessing. And if you keep on waiting, honestly, you're going to be waiting forever, right? Usually luck favors the bold and the brave. And basically when you basically make certain decisions and you move with conviction because you have the right knowledge, what you tend to do is you buy property and wait. You don't wait and buy property, right? So, like, there's really nothing to be fearful about if you know what you're doing, because confidence is derived from knowledge. And when you have the knowledge and expertise and you're able to navigate your way around a market, you're able to see the opportunities that other people don't see. Usually when you're kind of like coming from a place of fear or scarcity, it's often because you have a lack of knowledge in any given subject area. So why do I think like right now is a great time to invest, and like what are some of the market opportunities? Well, the biggest market opportunity that I see right now is this. At the moment, there are a lot of motivated sellers due to Section 24 and increased interest rates, right? And I'm going to explain this to you shortly and what this means. But there's also a new YouTube video being released this week called The Perfect Storm for New Property Investors. I'm just about to create this video. And in this video, I'm going to share with you all about the perfect storm, what it is, and how buy-to-let tax changes like Section 24 with increased interest rates on mortgages has caused existing landlords who haven't been as knowledgeable as they should have been, let's say, they've got caught out and they bought properties in the wrong way, why these type of landlords are leaving, and why that's creating an opportunity for people like ourselves and new property investors who are educated, who are informed, to go out and basically buy deals off motivated sellers, right? Because like I say, what is this, right? So Section 24 basically is a buy-to-let tax change that was implemented in 2016, and it was a 4-year phase plan that came out in from 2016 in April to April 2020. And it basically said that if you are an existing landlord and you had properties in your own name and you were a higher rate taxpayer, you could no longer offset your mortgage interest against your rental portfolio. So you're basically being taxed 40% or 45%, depending on which tax bracket you're in, on your gross rental income. Now, you can imagine if you cannot offset your mortgage interest against your rental income and you're taxed on the top line before you even deduct your mortgage interest, you can see that this is going to like eat into your profits, right? And so a lot of people and existing landlords were moving their properties from their own name into a limited company. But one of the problems right now, the biggest problem that these people face right now is that not only are they still faced with this problem of buy-to-let Section 24 taxes, they've also got increased interest on the mortgages that they're paying. So not only are they getting taxed 40 to 45% on the gross rental income before they can deduct their mortgage interest, their mortgage interest costs are going up as well. So if you think that they're being taxed 40 to 45% on gross income and their mortgage costs are going up, that profit that they had there before is even less. And in most cases right now, we see these people negatively cash flowing month on month in their portfolio. And so these people are now forced to sell. And this is what I call like the perfect storm, because these people become motivated sellers, and it gives an opportunity for people who are in the know, who are informed, or people who are new to the market to come in and negotiate some really good deals. Because you have to think about it like this, right? And this is what I find like very ironic. People always want to invest when a market is strong and when there's certainty. But when there's a certain market, you're going to make less money for sure. And the reason is because it's more competitive, and therefore it's harder to get a deal. It's harder to buy that property off market with a discount. But now, this is the biggest opportunity that I've seen for the last 4 to 5 years of being a property investor. Just in that period, I've been investing in property for over 12 years now, but in the last 4 to 5 years, I think this is the biggest opportunity that I've ever seen over a 4 to 5 year period, where we're going to see more distressed sellers, more people who are motivated to sell because of this big problem here, this buy-to-let Section 24 tax problem, where landlords have property in their own name, and the increase in mortgage rates. Those two things together, those two variances, are basically creating the largest number of motivated sellers in the market today that I've seen in a long time. And so that's an opportunity, right? So if there's ever a reason to get into property and why you'd want to invest now, it's so that you can go in and negotiate some really good deals. Now, one of the things that I want to talk about here is like making sure that you have an increased sensitivity analysis, which means that existing landlords will be leaving the market, which means less competition for new property investors entering the market. And so again, this is like what I talked about up here, this sensitivity analysis of like 5.5 to 7.5%. This is basically meaning that people are making lower returns because they're either having to pay down their mortgage to reduce their loan to value in order to hit the bank's increased sensitivity analysis, or they're having to sell their properties because they're no longer profitable, because they weren't at 145% at 7.5%, and they may have only been at 145% at 5%, and now the interest rates are at 6% on their portfolio, for example, they're no longer profitable. So they're having to leave the market, and they're being forced to sell. And again, the more that somebody is forced to sell their property, the more motivated they are to sell, the bigger the discount you can expect to pay. And unfortunately, whilst I feel sorry for these people, and whilst I want to create an ethical win-win, unfortunately the market is the market, and regardless of whatever happens on an ethical basis, like, we can't help that. I can't help it, you can't help it, the market just does its thing. And people get into these problems because they haven't future planned, they haven't future proofed. And the only reason they're in those problems 9 out of 10 times is because they've just missed out or lack the expert knowledge to understand how to offset future market conditions. Because whenever I'm investing in the market, I'm always investing to make sure that I have future sensitivity analysis within my decision-making process. I'm always looking to cover the worst case scenario. What happens if interest rates go from today's lending at 3.5 to 5.5 to 7.5, all the way through to 10? I want to have the finger on the pulse of my portfolio, so I know if interest rates go up, what does that do to my profit? If I'm still able to make profit at, say, 10% interest rates, then I'm still winning in today's market. I'm still in the game. I'm still there. I'm still able to grow my business. I'm still able to expand and leverage up safely. at 75% so I can grow effectively through the recession. And I'm still in the market to go and get motivated deals, right? And this is like the value of being in the know, right? The value of expertise, the value of knowledge, because it means that you no longer have to be fearful when you can capitalize on market opportunities, right? Now, like I say, these three variables, Section 24, increased interest rates for landlords who are susceptible to Section 24, who've got property portfolios in their own name, who cannot afford to reduce the loan to value against their portfolio, are basically being forced to sell. Now, the truth is that money loves speed. And we have a client called David in our program. And recently, over the last, say, 6 to 8 weeks, David has brought 3 properties with a 20 to 30K discount on each one. And ultimately that came about because he was a cash buyer, and some of the reasons that I've alluded to here about the other person being a motivated seller has meant that David can go in and negotiate some really good deals. Now, one of the other things why I think now is a great time to invest in property, and like what we're seeing, is because there's a real big imbalance in supply and demand. Like the UK needs to build 250 to 300,000 new homes a year for the next 20 years just to meet demand, right? So there's an undersupply of property in the market. This basically means that house prices are going to stay strong and over the long term are going to go up in value because every market is driven by supply and demand. And property is an income inelastic product. In the terms of elasticity of demand, it basically means that when a product is a necessity, for example, like let's say the person that smokes 40 cigarettes a day, no matter, and has an addiction to cigarettes, like they're still going to need cigarettes even if cigarettes went up from £20 to £30 to £40. They'd find the money to buy those cigarettes because actually finding the money is easier than breaking the addiction. Now, property works in a similar way and a similar principle because regardless of market conditions, people are always going to need a place to live. And this alludes to the supply and demand. Actually, what's going to happen right now is that if it becomes a renter's market because people can no longer afford to buy property and be a homeowner because interest rates are too high and they can't afford to get on the property ladder, and it becomes more of a renter's market, so there's an increased demand for rental properties but an undersupply, it means that you get this imbalance and rental prices will go up, which is another reason why you should be investing in property today, because I fundamentally believe that rental prices are going to increase during a recession. Now, the other thing is that property is an inflation hedge. So we all know that if you've got money sat in a bank account right now, that every day that goes by, in real terms, inflation is like 12 to 15% a year at the moment. And you're only getting like 0.5% interest on your savings right now. So the true value of your money is being depleted at like anywhere between 11.5% and 14.5% on a daily basis that the money is left in the bank. This is another reason why I put my money into property, because it's a commodity that I can touch and feel. And I know that if I keep it long enough, as long as I can secure rental demand, that I'm going to be bringing in positive net cash flow a month if I've done all of my numbers correctly, safely to 5.5%, 7.5%, 10% interest rates. If I'm profitable at those levels, I'm still active and still profitable during a recession, then in my mind, there really is nothing to worry about. I'm just focusing on the market opportunities that have come as a result of other people not being profitable at those certain metrics, right? So by investing in property, property is an inflation hedge. So we can basically means that our money is going to be working for us. So at the moment, I'm trying to get all of the money that I have in holdings into the property market because I can basically use it as an inflation hedge. My money is going up in value. My rents are going to increase because of supply and demand. And ultimately, because of that supply and demand and because the imbalance of supply and demand where we need to build 250 to 300,000 homes a year for the next 20 years, I strongly fundamentally believe with a growing population that the imbalance is actually going to move further apart and get closer together, meaning that house prices over the long term are going to carry on rising. And there is no argument or substantial data that I see that kind of offsets that. Because if we look at the house prices from 1958 to today, they've almost quadrupled. Like they've gone up like over 128 times by like 71-year period. If I look at, if I bring up in a minute the 71-year period from NatWest, the index, house prices have increased 128 times over that period. And there is no data that suggests that that trend wouldn't carry forward, right? So for all of these reasons, the fact that property prices are going to continue to rise over the long term, there might be some market fluctuations, but over the long term that they'll rise. Rental prices are going to carry on increasing for the long term because of the supply and demand. If anything, during a recession, rents increase because you end up with a renter's market, not a buyer's market. And because property is an inflation hedge, and coupled with the fact that we see these unique market opportunities where landlords who are susceptible to Section 24, who have properties in their own name and are making less profit, not only because of Section 24 buy-to-let tax changes, but because the increase in their mortgage costs every month, meaning they're less profitable, are forced to sell, we're able to go in and negotiate better deals as well. So I think personally, coming from a place of like being in the market, seeing this every day, like now is a great time to invest in the property market. And there's actually nothing to be fearful of. There's definitely stuff to be mindful about, for sure. And like you should be able to financially model these things. But if you can financially model the deal to know if your worst case scenario would happen, if interest rates were to go up to 10% during the time that you owned those properties, and you're still profitable, then you really have nothing to worry about in those circumstances, right? You're able to maintain profitable margins even when mortgages are at an all-time high. And that's a really strong place to be. Now, this brings on to like, what are the best strategies to adopt as a property investor right now? Now, personally, like this is like what I'm doing right now, what's working for me, and what like some of our clients are doing right now, which is working really well, is we're using the BRR strategy: buy, refurbish, refinance, repeat. We're buying properties for cash. So we're going cash in, so we have no debt against the properties, so we're not susceptible to market changes or paying an increased cost on our mortgage because there is no debt. We're going in with cash, and then we're able to refurbish the properties, force the appreciation, and we're buying from motivated sellers. And the reason that we're buying from motivated sellers and we're able to do that now more easily than when the market was strong, when interest rates were lower than they are today, is because of all of the problems that I've basically suggested are apparent in today's market for existing property investors, based on their unique circumstances of Section 24 and interest rates rising, and they've got the wrong property types in their portfolio. Because ultimately, if all you're doing right now is single lets, like it's quite tough to force the yield above 8% on a single let property unless you invest further afield in the northwest or the northeast of the UK. And therefore, lots of buy-to-let landlords in the UK who just have single lets in their portfolio, like, are really struggling right now to make ends meet, and the margins are very small, right? So it's not that attractive for them. But like, this creates an opportunity for us, as I've alluded to, that we can go to get motivated deals, we can force the appreciation, and then we can refinance them on a tracker or a discounted mortgage, right? So we're still able to benefit from the best profitable scenarios that we possibly can in today's market, right? Now, if you're somebody watching this video and feeling like, hey, I don't have the cash to go cash in, mortgage out, that's also okay. You can still go mortgage in, mortgage out, and it will work fine for you. Again, I would encourage you to go maybe bridging in, mortgage out, so that you avoid early repayment charges, or I'd encourage you to go with mortgage in, mortgage out, and go on like a discount or a variable, and so you're not fixed in for a prolonged period of time with a high early repayment charge, right? Now, one of the other things that you can do, like what are the best strategies you can do right now? Like I say, buy to let. If you are sold that you want to do buy to let and you've got your heart set on doing buy to let, then ultimately this is probably the least profitable strategy right now, because again, like I alluded to, you cannot force the yield high enough above 8%, typically speaking. So your margins are restricted when you have that increased cost of your mortgage from 3.5% to 5% to 6%, because that cost has gone up, and the rental income that you get isn't high enough to offset the increase in your mortgage. You end up basically with a small margin and only just making profit a month, or to being not making profit a month, right? Which is not where you want to be. But equally, like what I'm doing right now, if I'm investing for buy-to-lets, which I still am, I'm investing in the northwest, northeast of the UK, in areas where as long as I can get an 8% gross yield, then I know my property will still be profitable at 75% loan to value at around 5.5% to 6% mortgage interest rates. I can still make profit on those buy-to-let deals, and I can still get good returns and good return on investment, right? Now, other strategies that I think personally, if you're in a position where you can do this, then you should. If there was like, Rich, would you choose buy-to-let, or would you do HMO or service accommodation or title splits, or what strategy would you use? Ultimately, right now, like, I'll be doing HMO, title splits, or service accommodation. And the reason why I'll do these specific types of strategy is because you can really force the rental income on those specific properties much better than you can on a single let. Like, let's say you have a property that's valued at £150,000 in the Northwest, for example, and you get £1,000 a month, or £850 to £1,000 a month rent on that property, right? Your margins are going to be lower than if you have the same property for £150,000, but you're able to get £2,500, for example, from renting out 6 bedrooms in the property than if you were just to rent on a buy-to-let tenancy with just one person in there or a family, right? Your yield's a lot lower on a buy-to-let than it is on an HMO. The reason why we want to force the yield as high as we can right now is because the higher the yield means that as interest rates rise, we are still profitable. So we can still maintain those healthy margins, which is why I recommend HMOs and service accommodation for that reason. And another thing that I'm doing a lot of at the moment is title splits. I might buy a 2-bed terrace property. Rather than renting it out for like $450 a month to one family or one person or a couple, what I'm going to do is I'm going to split it into a ground floor flat and a first floor flat. So I'm going to do a buy, refurbish, refinance strategy. I'm going to buy the 2-bed terrace, split it into a ground floor flat and a first floor flat, and instead of charging $450 for one property, I'm going to charge $450 each flat, and that's £900 rent from the same asset that would get £450 rent. That means I increase my margin, and it allows and gives contingency for increased interest rates right now, okay? And again, like I say, like, this video is like quite high level in terms of like what's going on in the market right now. Why should I invest in property right now? What are the market opportunities that are unique to property right now? And why, like, would somebody like Rich, for example, like myself, say that getting into property right now is still a very solid investment? And why, like, you can make, fundamentally, just being honest about this, why you can make a lot of money right now based on current market conditions, right? Because it's high level, and for the reasons I've just mentioned, like, I've created another video, a YouTube video, all about HMOs and all about title splits, so that you can see that you can still make very good margins at the higher interest rates that we're experiencing today. Okay, so go and watch one of those videos as well. That will be on my YouTube channel. And then the other thing that I'm doing a lot of right now, like, a lot of my properties right now, I'm converting from, like, say I've had 5-bed HMO property and I've been renting it out to professionals. What I'm doing right now, because of the increased utility costs, and sometimes it's not always possible just to pass it straight on to the end tenant, what I'm actually doing right now is I'm converting those properties or switching those properties from 5 professional tenants into a government-backed contract with people like Serco. And I've negotiated 5-year leases with these people with guaranteed rents. Now, what's great about this scheme is that they basically pay for all of the maintenance. They pay for all of the bills, gas, water, electric, and council tax. So basically, as a landlord, I'm now not hit by increased utility costs, right? And I'm still able to get I'm still able to get guaranteed rent for my property above and beyond what I would get in a buy-to-let scenario. Yes, when I negotiate these government contracts, I accept lower than market rate, right? But even if I accept lower than market rate for a 5-year guaranteed lease with a provider like Serco, who house asylum seekers, I'm still going to be able to fill my properties with predictability. I've got 5 years of guaranteed rent, and I'm actually saving 32% on my costs anyway, which means in most scenarios, I'm actually more profitable than if I were to rent this out at full market value, because I don't have to pay my letting agents anymore at 12%, and I don't have to pay utilities, which is about 25% of gross rent is what we allow for gas, water, electric, and council tax right now on a HMO property. So I'm saving like 37% straight away by not having those costs. Because like I say, in these specific types of properties, the government basically pick up all of the bills, the gas, water, electric, council tax, so we don't need to worry about increased rises in utility costs. And the other thing is that we've got like we don't have to worry about things like as well about like people leaving, new finders fees, fluctuations and void periods. We've got none of that to worry about. And you don't need an agent if you're doing these. You don't need a management agent. Like these properties are 4 hours away from where I live, and I just have a fixed contract with the government, with Serco Direct, and I manage it that way, and it's very easy. Okay. And again, the other thing that you can do is like student HMOs as well, where basically bills are included. So if you have a student HMO in an area like Oxford, where I am, you can basically rent out HMOs and the students will pay the bills. And also students are exempt from council tax as well. So it's these unique strategies that I'm using that means that my property portfolio is still very profitable, even though interest rates are rising a little bit. And we've got things like nuances of like increased utility costs to think about. I'm able to offset them, eradicate them just by being adaptable to the market. And if you're adaptable to the market, it's a great market right now to capitalize on market opportunities. Okay. Now, last one, like summary then, like my key takeaways. So make sure that you're adaptable, to market conditions I've explained about in this video. Like there are always opportunities. And like the other thing I want to share with you, right, is in my program, Property Investors Accelerator, we do collab calls. Now, these collab calls are great because we go through like nuances on a daily basis of like market conditions. Every week, twice a week, we get together, we talk about what's going in the market, and we have people inside the program, like one of our clients called Brian, who works for Investec, who are a private bank. Like we're able to get unique insights into what's happening in the market today. We're able to get the absolute truth from individuals about what the banks are seeing right now, how are the banks positioned, and therefore we're able to get a great indicator of what is happening and what we expect interest rates to be in the future, now, and in 1, 2, 3, 4 years from now. We're able to get unique insights, being surrounded by people in the know and the knowledge. And ultimately, when you're in that environment and you're like investing in an environment where people are doing deals right now and you're seeing more of what works and more of what doesn't, you're able to adapt your market conditions and your business model so that you're able to be extremely profitable and be one of those people who in a recession does make a lot of money and capitalizes on the opportunity and buys property and waits rather than waiting to buy property without being in the know, right? Now, one of the things that Brian said the other day on the collab call is that banks are under pressure right now to lower the interest rate as soon as inflation settles. And the reason for that is twofold. One, because the government has built up a huge deficit with the whole pandemic situation. And then the other thing is like as well is not only do we owe like lots of money as a nation, as a government, and we've got to basically pay back the government debt. The more that interest rates increase, the more that the government becomes in debt, right? So if we want to reduce the government debt, which they ultimately do over the long term, is they're forced to like say, hey, look, as soon as we can, as soon as is practicable and as soon as is possible, like banks, you need to lower your interest rates to start to stimulate market economy again. The other thing that Brian mentioned the other day is that a lot of these banks like Investec are sat with a lot of money on deposit, and banks don't make money when they're not lending. Banks make money from lending. They want to lend. In order to encourage people to go to the bank and get lending, they basically need to reduce their interest rates to make it more of an attractive and profitable proposition for people to go and take out loans with them. So believe me, as soon as inflation starts to flatline, starts to settle, we will see interest rates come down. The other thing that helps us to be by being in these programs, like the Property Investors Accelerator program with the collab calls, is that you're at the forefront of market activity. You're able to know what's going on at any given moment, and you're able to be adaptable. And ultimately, you're able to enter the market where there's the greatest opportunity as opposed to a strong market that is competitive. Right now, we have a plethora, an abundance of market opportunities. Like, you don't want to invest in a strong market. Like I promised you, it's a false sense of security. Investing in a strong market when interest rates are good are favorable for you as an investor because you can borrow cheap money. I get that. But actually, in those markets where it's very competitive, it's very difficult to get a deal. And therefore, what I'm suggesting that you do and what I'm alluding to is actually get in when there is an element of instability, because you can be the people that capitalize on the market opportunities that are there because of the instability that wouldn't be there in a strong market, like the things I've talked about, the Section 24, interest rates rising. Those two things together are creating so much problems for existing property investors who are in a situation where they own properties in their own name and they're unable to basically reduce their mortgages, and they're not profitable anymore, they are becoming motivated, which means that we can go in and start to negotiate discounts. So listen, if you enjoyed this video and you want to find out more and you want to come from a place of strength and you can rationalize that some of the points I've made here today make sense and you can see that there actually is a market opportunity and you want to learn more, we've just opened up a few spots in my flagship training program, Property Investors Accelerator. In Property Investors Accelerator, we only work with 360 clients a year. We've just got a few spots opened up, and be warned that as soon as we fill the last few remaining spots, we will be closing down applications. So if you do want to be one of those people to take advantage of the current market, to get in when there is this opportunity to be had, then click the link below. There's a link. You can go and schedule your call. You'll get to speak to one of my sales team. We can work out whether we're a fit or not, and if you're a fit, we can start working together. So thanks for watching. I hope you enjoyed this video. If you want to get involved in property, click that link below. Go schedule the call. It's in the description below this video. Go schedule a call with one of my team, and hopefully I'll see you soon. And last but not least, if you like this video, please go and hit that like button, hit the notifications bell icon so that you can be notified when new videos come out, and subscribe to the channel if you haven't already. Great. Thanks for watching. Speak soon.